Well, things are getting a little bit crazy in China, and we want to talk implications of, well, first, not only talking about what's happening in China, but then talk about how that could affect global markets. We'll talk a little bit about oil. We'll also talk a little bit about peak inflation here in the United States and what could keep a rally from happening in the stock market towards the end of the year. Let's talk about it. So, first, regarding China, last week, we reported that The Economist suggested we could see as many as 1.5 million deaths in China over the next few months as we get a big COVID wave. And we started getting reports that flu medications were starting to sell out and that pharmacies were essentially restricting individuals from purchasing more than one of any kind of fever medication or even something as simple as ibuprofen to prevent hoarding, unless individuals appeared to have symptoms, in which case they would sort of open up the floodgates and let them buy as much as they wanted. Well, now things appeared to have worsened over the weekend. On Saturday, we started hearing that coroners, mourners, they use the word interchangeably in China, apparently, in translations. But anyway, basically, companies that take care of dead people and cremating bodies are reporting 3 to 4 times the number of usual cremations. Some talk about refrigeration trucks being ordered, 24-hour-a-day operations. Now, lines not only to drop bodies off, but pile-ups in hospitals. The lines at pharmacies for fever medications getting even worse. There's now even talk that police are holding back the media from crematorium lines. Beijing's not reporting really any official changes in COVID cases. They're reporting 2 deaths have happened over the weekend. And this is mostly because the Chinese government is suggesting that they're only going to count cases and deaths from people that have tested at their facilities. But I think they're shutting down most of these facilities. And what seems to be happening right now is this sort of let COVID rage kind of mentality. And so there are estimates that anywhere between 500,000 to 1.5 million Chinese could die in the next few months, which is pretty impactful. The R0 number, the number of people that one person can infect in China, is thought to be quite high. When COVID first hit America, we thought maybe 2 to 3 individuals would be infected per individual who got COVID here in America when we first got the first wave in America. That went up to as high as about 10 to 11 during Omicron. China is deemed to be at potentially as high as a number of 16. That brings the doubling rate for COVID to within hours rather than days in a country that seems to have very little herd immunity. Even though 50% of their population over 18 is vaccinated with the Chinese COVID vaccine, it's deemed that a lot of these vaccinations were conducted a long time ago and that they're just not valid anymore. And only 50% of those over 60 have had their 3rd shot, which also probably was given way too long ago to prepare for the wave here. On top of that, the latest variants of COVID are showing, more stubbornness against the existing COVID vaccines, which creates really a unique challenge for China. Remember that when Hong Kong last year was hit by Omicron, they had about 3 to 4 million cases in 3 to 4 months. Official statistics reported just 5,900 deaths, though nobody really believed that. This surge is expected to be substantially worse as it spreads over mainland China. And in the short term, the economic issue could be quite devastating. We could see plummeting demand for oil between now and probably the end of February, which has substantial disinflationary forces for the world. Do keep in mind that when we look at inflationary statistics, a lot of folks look and say, oh, well, if we strip out energy, inflation is doing X, Y, Z or whatever. But stripping out an energy is really quite misleading, given that pretty much every single product that we use on a day-to-day basis involves energy and oil. It's not just the coffee in your coffee cup that is transported with oil, or the plastics in your remote controls, or the computers you're using. I mean, oil is ubiquitous to our lives. From solvents to sealants, it's really incredible what we use oil for. So seeing a potential massive decline in demand in China over the next 3 months could actually lower the cost of energy quite a bit. However, we think that this shutdown of schools and potential factories in the short term, as not because factories are being forced to shut down, but because people are just all sick. And if everybody's sick, there are just fewer workers available in China as the world sort of goes through getting used to being exposed to COVID. We could see a pretty depressive economy for China for the next 3 months, which I believe will be quite disinflationary for the world. You'll have this sort of anchor of a shock of deflation, at least in the short term. Now, what's interesting will be how China ends up reopening if there are no forced shutdowns in China, and the official policy of China is to turn a blind eye all of a sudden as they undo their COVID zero attempts. It's entirely possible that it is come after like post Lunar New Year China, February, March of 2023. We could actually see this sort of massive decrease in spending reverse. And you could kind of see what you saw in the US and Europe, which was a pretty inflationary disruption of supply chains and massive spending, especially since China has already been stimulating. They've been supporting their property sector. And so the question really now is, hey, even though China has an aging population, how high is that potential that we could see an inflationary surge come the second quarter of 2023, and we could see something like what we saw in the US and Europe. Now, at the same time, if we have an inflationary surge in Q2 2023, is it possible that the US and Europe could actually be in a deep recession then, as our central banks, both the ECB and the Federal Reserve, have over-tightened, which many now believe is a reality? We'll see. But it's these sorts of fears that could potentially lead any kind of risk on rally to sell off towards the end of the year. It seems like we're almost in borderline capitulation preparation, where individuals are taking any potential little rally and selling it as a way to buffer their portfolios. Take, for example, after Elon Musk's poll to step down from Twitter, ending result being 57% yes, 47% no. Tesla seems to have sold down from being up about 5 to 6% in pre-market to only being up about 2% now in pre-market. Market's about 1 hour away from opening, 52 minutes to be exact. It's possible that this any kind of Tesla rally returns during the day. However, it does seem like any kind of rally that exists does get sold off, especially when the NASDAQ is basically flat at just 10 basis points up. Some are calling for peak inflation, though just as many firms are calling for peak inflation or saying don't get too excited. For example, Chief Investment Officer of global private equity firm KKR says now's the time to add risk. And even though they see EPS declines for 2023, see glorious rebounds in 2024 that they think will start getting priced in as soon as 2023, which may be true because after all, the stock market is forward looking. And the stock market has been trying to price in 2023 EPS declines for a while now. Of course, then you've got folks like Bill Dudley saying, don't bother, the market still has another down leg to go. That leads to a lot of potential sell-offs for any kind of short-term rallies we get. In crypto world, Binance is apparently going to buy Voyager Digital's assets for about just over $1 billion, $1.022 billion. That'll be interesting. I think that's a sort of a way of Binance trying to suggest, don't worry, we're still alive and strong and well. We can buy other companies out. We've also got reports out that in Germany, prosecutors are potentially investigating allegations of, quote, unauthorized dangerous goods storage at Giga Berlin in Germany. Potentially some violations of battery material storage. So we'll see. Okay, so this creates a very interesting next few months for equity markets around the world. I think the big key for everyone is doing your best to stay out of margin as much as possible. And the big key is going to be which companies are actually going to show EPS growth next year. This is the kind of positioning that I've really followed, although it's been very painful recently. It'll be interesting to see if it plays out well in 2023. One of the things to remember is that any kind of stock market positioning never does well in every single market, but one that consistently tends to perform well, at least, or looking for companies with high EPS growth and high free cash flow. I believe those personally are companies that have pricing power, those being companies like Tesla, Apple, NVIDIA, AMD, SolarEdge, Generac. These are companies that I believe not only have high free cash flow, but also high pricing power. And so we'll see how that evolves in 2023. We'll definitely see how that evolves with the expansion of what appears to be an unmitigated spread of COVID in China. And how that ends up impacting manufacturing supply chains is a potential downside risk for the global economy. Though at the same time, the less spending occurs in China, the more that is potentially disinflationary for the world at a time where everybody still seems to be fighting inflation pretty heavily. So we'll see. It's going to be really interesting. It's going to be really interesting to see how things evolve. So we'll see how the market opens up today. Thank you so much for being here for this sort of morning update, and we'll see you in the next one. Thanks. Goodbye.